Welcome back to our monthly series with Greg McGeorge and JMI Wealth. This month, Greg is going to be talking about private equity, and it's a popular subject given the recent news about the Warehouse and Arvida group potentially purchased by the private equity firms. Now, Greg has over 35 years of experience in financial markets, both here and in London, and JMI Wealth looks after 6.5 billion of investments. So Greg provides bespoke wealth management solutions backed by an award-winning investment team. So if you want to chat more with Greg, then or your investments, or the market in general, then you can find him at jmiwealth.co.nz. And now we also have another bit of news that we're talking about. So this wee chap here might be familiar to a few of you watching throughout New Zealand. This is Harold the giraffe. And Greg, we've spoken about your sporting achievements of late, haven't we, in your rowing challenge. So please, Greg, give us a quick update on what you're up to with Harold and your rowing.
Yeah, actually, I think you are to blame for a lot of this, actually.
Yep.
So I've continued my 2 million metre rowing challenge, and I thought this time, hey, why not do it for a great cause? And I met up with some of the people from Life Education Trust, and I was blown away by what they do for kids, and a lot of it really resonated with me. The financial awareness they do, and then also stuff around body positivity, healthy vaping. I had no idea how out of control that was. So I'm trying to raise some money so they can put more hours into helping our kids have a better future.
Yeah,
and Harold is the man.
He is, yeah. So Greg is rowing 2 million metres and raising money for Life Education Trust. For every $2,500 raised,
I thought you'd...
Greg then has to go and do a half marathon on a row on an erg in one go. So that's no mean feat. That's 21.6
21,097 metres.
Tough. Now, not to make this about me, Greg, but you did then stitch me up with this. And so he's a rower. I have been a runner in the past, maybe 10 kgs ago. So I wasn't willing to run 2 million metres. So I'm just going to be doing 2 million inches instead. So it is still 50.8 kilometres. I'll be raising money for Harold as well. The last run I did, I was able to raise $4,500. So I too would love your support with this, but fund Greg first. But on the 3rd of November, which is also the same day that they do the duck race out on this river behind us,
which is Life Education Trust.
I'll be running 20 laps of Hagley Park, 2.5k circuit. It'll be a challenge, but I do it because, what Harold supports with these kids, it's all about a challenge. It's all about, dealing with creating mental resilience.
Yep.
So
I think
Harold.
I think we need to go bigger though. I think we just have to have a general 2 million challenge.
Yeah.
Don't care. If a group of you want to do 2 million of something, great. Let's start a theme, the 2 million challenge.
Yeah.
There you go. Want to hear your stories.
Awesome. Thanks, Greg.
Cheers.
Cheers. So, Greg, private equity is in the news. Tell me, what's going on?
Correct. Private equity, or PE, as we call it, has indeed been in the spotlight here in New Zealand recently with 2 deals you just mentioned, but it's also been hitting the headlines overseas for quite a while now, and much to the amusement of other parts of the financial market community. So historically, PE firms have been one of the best performing asset classes year in, year out. Over the past 20 plus years, private equity firms have churned out distributions worth around 25% of fund values each year. But according to one recent survey, distributions in 2022 plunged to 14% and then fell even further in 23 to just 11%, some of the lowest returns since 2009. Also, the valuations of the companies they invest in aren't increasing as they should. They are also struggling to deploy the cash they have, and they can't get out of the investments they do have. In fact, PE exits from investments in 2023 were down 25% on 22, and 22 was a bad year. All right? So many in the market have a view that PE, private equity firms, consider themselves to be superior to the rest of the financial sector. So there's very little transparency about PE firms, what they do. They charge really high fees. So their current struggle to be treating as long overdue comeuppance by other market players, and they aren't too upset to see what's going on.
Yeah. So how does private equity work for those out there that might not be familiar with it?
So the term private equity actually covers a few different stages of investment, but PE is mostly associated with the simple concept of buying a whole company, making it better, and then selling it at a higher price. The version of PE, private equity, we see in the media mostly relates to these firms buying mature businesses that have strong potential for growth but might not have access to the traditional public capital markets to help fund them grow, or they might look to buy businesses that they think are undervalued or just poorly run. And you mentioned the example of the Warehouse and Arvida. For those deals, the private equity firms actually are looking to buy a publicly traded company and take it private. But the majority of the PE deals involve going the other way, purchasing a privately owned business and then taking it public. So their goal is pretty simple. They look to invest capital and use their expertise to help the businesses expand. They improve operations, look to increase profitability, and then flip it at a profit. And the main way they exit their investments is by either taking the company public through what's called an initial public offering or IPO. So this simply involves listing the shares on a stock exchange. So they then sell their ownership to the public. Or they look to sell the business as a whole to a competitor. But there are other options for them to get out, such as selling to another PE firm or selling parts of the business, depending what the market's doing, or even taking on debt to repay them themselves.
So, a kind of supplementary question here. Do you find that they're usually wanting to recycle their cash out pretty quickly, are they?
Correct.
Is that how they make this money?
Correct, and liquidity is gone.
Hence the slowdown?
Yeah.
Right. So Greg, you mentioned the term private equity. It covers different stages and subsets. Tell me a bit more about that.
Yeah. So the term PE, private equity, actually covers several different subsets of investing that we usually don't actually hear much about in the media. So PE firms create pooled investment funds. So they're not individuals, but at the very earliest and riskiest stage of investing, this is when a business is just an idea and lacks a business model or revenue, you will find what's referred to as angel investors. Although they aren't technically private equity funds, they have many very similar attributes. Angels tend to be high net worth individuals who invest their own money for a small ownership stake while providing mentoring and support to help grow the business. The TV show Shark Tank is probably a good example of an angel investor, although some of the deals they negotiate are pretty aggressive, so they probably wouldn't sit too well with most angel investors. The next subset of PE comes in the form of venture capital firms, or VC. So PE for private equity, VC for venture capital. Unlike angel investors, VCs are investment businesses with pooled funds from multiple investors, and these can be wealthy individuals, but they're also pension funds, insurance companies. These are investors who are happy to have their investment tied up for many years while the VC firm grows the company. And like the angel investors, VC firms target very early stage, high growth startups whereas the PE firms more focus on established and mature businesses. So the VC firm will also provide strategic guidance, networking opportunities, management expertise, and it will also manage the different stages of capital raising, which is really important. And these are referred to in the market as the Series A, B, C funding rounds. So just to explain them, the first stage, Series A, is when the business is still very early days. If things proceed well, the VC company will look to raise more funding with a Series B round of capital raising. Now, this is when you have a company with a commercially viable product and it needs further funding to scale it up. And then the Series C is the much later stage of the company. This is where capital is sought to develop new products or acquire other companies. So with these very early stage VC deals, a common theme is the original owners sell an ownership stake to these investors to attract the investment and their knowledge and resources, therefore enabling the company to grow and expand without having to take on debt. Now, this is really important to remember, and we'll talk about this a little bit later. So once the company is mature and making money, the next stage would involve listing the company on a stock market and selling shares to the public to help raise further capital to buy the business or to help grow the business, or even selling it to a competitor. And some of them even sell it to private equity funds.
So do you have an example of where this model has worked really well?
Yeah, actually, I think Amazon is a great example of how that private equity model should work, which we just talked about. So Jeff Bezos started the company in '94 with about $250,000 in funding from family and friends. So this referred to as initial seed capital. Shortly after that came the angel investors in the form of several high net worth individuals who all had a track record of success in the tech space, and they mentored and guided Bezos. Then came the venture capital firm in '95. They invested about $8 million and took a 13% ownership, valuing the company at about $60 million at that stage. So this particular VC firm didn't follow the traditional Series ABC funding rounds that I mentioned. They instead went straight to listing Amazon on the tech-heavy NASDAQ stock market with an initial public offering. Now, why I like this one is the whole process worked really well, and all the investors stayed fully invested and didn't sell. So new shares were created and issued at the IPO, and all the new capital raised was used to help Amazon continue to grow the business to become the $1.8 trillion company that it is today.
Right, Greg, so those stages are subsets of private equity. So how does a PE firm differ to a VC firm?
Yeah, so the big difference is debt. VC firms do not use debt, but PE firms love it. Absolutely love it. And they use it for something called leveraged buyouts, which is the standard operating model for these guys, for these PE firms. So how it works is private equity firm will have a large pile of cash, which they've received from institutional investors. They'll use part of that pile of money to buy a company. Now, the most important feature of this purchase is that they don't actually use that much of the pile of money, right? Most of the purchase is paid for by borrowing a lot of money. These PE firms own the company in much the same way most of us would have purchased our first home, with a tiny slice of equity, or our deposit, and a big mortgage on top of it. And it's important to understand the structure as well. It's the company they buy, not the PE firm that has the debt load, all right? So the PE fund uses the assets and cash flows of the company they are buying to secure and fund the loan. So there's no recourse back to the PE firm, whereas us, there's total recourse. And it's this massive debt load that's responsible for a lot of the problems that PE funds are experiencing, which has resulted in the market stalling. As you can imagine, this practice receives a lot of criticism in the market. They pile a huge amount of debts onto a company, and if the company happens to go bankrupt because of this immense pile of debt, it's suddenly the lender's problem. The private equity guys, they simply walk away having lost their deposit, although when I say lost their deposit, all right, PE firms have this wonderful thing called dividend recapitalization, which involves them borrowing even more money against the company and using that borrowed money to pay themselves a dividend. Hence my earlier comment why not too many people in the market are feeling desperately sorry for them at the moment.
Yeah. They seem quite self-serving and
And the culprit for their problems has been the sharp increase in central bank interest rates globally. So since rates started rising, the IPO market has frozen up, the number of mergers and acquisitions has slowed, and these are two key ways for PE firms to exit their investment and get their cash out. Of course, the vastly increased interest costs these businesses are having to pay is also having a really negative effect on the company's valuation, as you can imagine. So now these companies are also worth a lot less to sell than what the PE firms originally thought. Yeah. And as I mentioned, PE firms put debt under the company they just bought. But there's a new worrying trend that's starting to happen, and classic sign of stress is that now some PE firms are also borrowing at the fund level and then injecting that money into the companies they own so that company can meet their loan payments. Wow. Whereas dividend recapitalization is sort of an accepted practice, borrowing at the fund level is getting some investors asking questions and are getting very, very nervous.
Right, Greg, so you've spoken about the fact that, of course, returns are down. These businesses might be suffering a bit with it being heavily debt-laden, but you also mentioned 12 to 14% per year. That doesn't sound too bad to me. So, but what are we going to see next from these PE firms? Are we going to see the companies that they're running, filing for bankruptcy? Are they not performing?
Yeah. Let me talk about those returns. But I know, right? Give me 12 to 14% per annum all day. Thank you. But you also have to consider the other things that go with PE, things like liquidity premium. These funds usually have little or no liquidity, meaning your investment is tied up for many, many years. And investors often forget the importance of liquidity in their portfolio, especially when the market's going south. Suddenly investments they thought were easily accessible or easy to sell are locked down, or they need to take a big loss to get out. So there's that you need to factor in. And you are committed investor until the PE firm sells the companies they bought. So you usually can't sell the stake you own to a new investor. So you don't even have that option. Yeah. Also, there is opportunity cost to consider. The way PE firms or new funds, PE funds, raise money isn't very efficient for an investor. So they have a thing called a capital call. So as an investor, you don't put all your money into the fund on day one. You only put money in when the PE fund finds a company to buy. So they will then ask for a portion of the funds you have committed to invest. So this whole drawdown process, it can take 3 to 5 years while they're trying to find the companies to buy. So during this time, your funds need to be readily available, and they're usually sitting in a savings account. So you're therefore missing on other investment opportunities while you wait to get fully invested in the fund. And you asked me about PE funds, some of the firms they own going bankrupt, and yeah, absolutely, it's possible, and we have had some recent examples. Even the very best PE firms like KKR have seen some of their investments go bust. Last year, KKR owned Envision Healthcare, and they filed for bankruptcy. It was $8 billion they had of debt. Yeah, but in one of these talks a few months ago, I talked about private credit and the growth of that. So that's where more and more lending to corporate America is being done by non-bank banks, and that's including in that non-bank lender are these PE firms. So they've set up their own lending business, private credit, using investments from these same pension funds and insurance companies. And in fact, some of these PE funds have gone out and bought insurance companies, so they have a guaranteed cash flow into their private credit fund. It's beautiful. So, but the problem with that, you now have the situation where a pension fund will invest into the private credit fund. The private credit fund, which the PE fund owns, will then fund the debt for its own PE firm's leveraged buyout, which the same pension fund is probably also invested in the PE fund. So it's all starting to get quite circular. And due to the lack of transparency, private credit and private equity falls outside of the regulator's view. It does have some regulators worried about the amount of leverage that actually is out there. But the reality is private equity is an extremely important asset class mechanism for raising capital to help companies grow. It might be struggling now, and maybe we're just all jealous of private equity, but with global banks about to start cutting interest rates aggressively, we might be ready for the return of 20 plus returns within private equity.
Wow.